Welcome to this week's edition of Trade the Trend. It is Friday the 17th of September 2021. I'm Jason McIntosh and I'll be bringing these videos each week, focusing in on some of the opportunities, some of the trends that I'm seeing develop in the markets. And look, of course, if you like what you see, please hit that like button. Let YouTube know that you like what you're seeing and I'll keep showing it and I'll keep making them. So look, everything's general advice, not tailored specifically to you. But with all of that said, let's jump into the first chart. So S&P 500, and what an interesting week it's been. It's look, we spoke about this last week. We were right around this point here, and we were discussing the possibility of some sort of a pullback developing in the markets. Nothing too ominous, but some sort of a pullback nonetheless. And that's kind of been unfolding over the last few days, and it's interesting looking at the market here. So the last 4 days, the market's been sitting right on its 50-day moving average. That's interesting in itself because if we look down these previous touches of the moving average, the market's hit the moving average and then ricocheted back off and headed up towards new highs. It hasn't spent much time there. You can see these are just like 1 or 2 days before we've gone up. You've got to come back to around here in February before it spent any time really at all clustered around the 50-day moving average. So on that basis, look, I think that is a little bit of a red flag for the near term, and what direction the market may be about to take. Now let's focus in on just the last month. Just this little area in here. I want to take a close look on that. And to do that, let's jump across to an hourly chart. It'll give us a bit more detail. So now we've got that hourly chart there. Let me just clean this up a touch. Now, okay, so let's start by putting the Fibonacci's on. If you don't know what Fibonacci's are, just jump onto Google and type in Fibonacci levels. They're technical levels which a lot of traders use. Gives us a feel for where markets might pull back from, and we can use them for projecting price targets, and they're really useful. And so what we can see here is that we had the rally to the new all-time high. Pullbacks actually become quite a large in proportion. Proportionally, it's quite large relative to the run-up that we had. It's come all the way back to the 61.8. which is a sign of relative weakness because it has come back so far. So we did bounce, like it's amazing. It's uncanny how these levels do sometimes come back right to the dollar, and this one pretty much did. So it got down here and we got a nice rally. It was a strong rally off, looking encouraging at that point. But then we've had this really sharp, the rug's really been pulled out from beneath the market here, and it's come back down really quickly. And it's kind of now making me feel this market is quite heavy. It's struggling to move forward in the near term. So let me just take that Fibonacci off and let's put on another one projecting down from the high. This gives us an idea of the strength of the rebound, and the rebound has only come back into this early stages of those retracement levels. So where we saw this point down here had come all the way down to the lower end, this has only come to the early portions of it, which is it's a sign of relative weakness in this market. What I'm concerned could happen here is that we get something like this over the next couple of days. So I'm recording this, of course, on Friday afternoon. I don't know what we're going to see on Friday night. But what I'm worried we could see develop is something like that could take shape. Look, we'll know more shortly, but I think the levels to keep an eye on are, it's pretty much around here on the lower side, and on the upside we're looking at something like that. And yeah, if we do break this level here, it does open up the possibility for this pullback to really start to extend itself. Unless we can get up above, say, 4,500, it's this is something we do need to keep an eye on just now. So let's come back over to the daily chart, And okay, so we'll just clean these little lines up. And okay, so what happens? What happens if that breaks? Well, if the market does break down here, it brings into focus a support level down around here. So there's clear support in there from these previous highs and this previous low. We also have the 100-day moving average. That's going to become a focus point down around there. And it's interesting, we haven't been down to the 100-day moving average since, you've got to come all the way back down here in November, since the market's had a touch of there. And it's really only since this whole recovery from the COVID lows, yeah, look, the 100-day moving average hasn't had too much activity. The market hasn't gotten down there. Whether it's going to happen now, I don't know. But it's looking like more of that possibility is becoming more likely as this market struggles to regain its footing from this pullback. So look, and if that were to happen, I don't think it's anything particularly scary. Like we just measure down from here, and what's that? It's around a 6%, 6-7% back down to here, and that's if that were to happen. So I don't think anything scary is on the horizon at this point. But look, we've got some levels to watch, and there is the prospect that we do start to see more of a correction develop in this market, which we haven't seen for some time. So jumping quickly over to the Dow. Well, look, the Dow's relatively weaker, whereas the S&P 500 is sitting up here on its 50-day moving average. The Dow's sitting down here on the 100-day, and it's look, it hasn't been below the 100-day moving average since November. Coming back all the way back down here. It hasn't broken at this point, but again, it's looking somewhat heavy. If it breaks, the support on the Dow would come in around, I'd look at these levels through here. So you can see we've got some previous highs. We've got a low there. If we break the 100-day moving average, I think this is sort of the area we'd be looking. And again, as a rough guide as what percentage that is, again, it's like just like the S&P, it's around that sort of 6 to 7% sort of mark, which in the scheme of things is very routine and nothing out of the ordinary whatsoever. The transports, which we looked at last week, it's worth looking at again, because like last week we were looking at this pattern here, which this wedge type formation, which the market had broken down from. Let me just draw that in there. So yeah, so we had the break here. It's continued lower during the week. The last couple of days it has rebounded. What I don't like about this is the rebound. So if we just look at this day here, this was Thursday in the US. Markets opened here. You can see the little dash there, rallied up to just beneath the base of the wedge, and it's come and it's closed lower on the day. So it's actually quite a weak day. I don't think this market's out of the woods by any stretch. I think look, my base case really, I think that market's going to come back and test down here, come back to at least the base of the wedge, and then we see what happens. If that flows through to the other markets, well, that's possibly a hint that we are going to test a little bit lower. The bright spot in all this though is the Nasdaq. So this is why I think there's nothing really scary in the makings here, because the Nasdaq hasn't even come back to its 50-day moving average. So there's no topping pattern evident in this market. And look, if it makes me think, if these markets do sort of start to test lower, that it's nothing more than a mundane routine pullback. So nothing to get too worked up about at this point from everything that I'm seeing at the moment. So jumping to the All Ordinaries. Now, the All Ordinaries is a different one. We've been looking at this trend channel for a few weeks now. I'll quickly just draw that back in on the chart. Let me just start that again. I got the wrong starting point. So the trend channel comes up around here. just fit that around those highs. So it's been moving nicely in this trend channel, and we've also got the support around here. So we've got these previous highs which have been acting as support. We've got a low there, come back perfectly to it there, and it's bounced. That's all good. That's all good so far. However, the dreaded however, let's get rid of all that, so clean that up for the moment. This is what I don't like about the All Ords. We've got these flagging formations which have been formed. So we had the move down, went into a sideways flagging formation, then we had the move down again, and now we're getting, just this week, this is what I've been watching this week, the bounce off that low, it's forming another one of these flagging formations. It's coming in like that. So if this sort of zigzag pattern was to repeat, you get another zigzag here. And what I'm concerned about is on Monday or Tuesday, we've got a bar like that developing on the chart. I've got to say, I think that's my favoured case at the moment, that's what we're going to see. If we do get that, support comes in at around somewhere through here, lining up these lows with this previous high, another high there. So you've got a potential move back down to there, getting a measurement on that. How far is that? It's around 6% from the top if we were to come back down to there. And it's got to break down below the 100-day moving average as well. Just like the Dow, we haven't touched the 100-day moving average since November. So look, a touch of the 100-day moving average is, look, it's overdue, and maybe this is where that's going to happen. I actually did a little bit of hedging this week. It's been a bit of a stop-start attempt at hedging. I did BBOZ was the product I used. And it was only it's about probably a bit under 20% of my portfolio. So it's not the whole portfolio is not hedged by any stretch, but it's just, look, I can see the potential for weakness. I thought, look, I just put a little bit of hedging on. This was the day I did the hedge, put it on there. Next day the market fell, so that was good. Closed fairly well though. So I thought the market might have closed down here. And then the next day we open up and we have this stronger day. And just as we started to break above these highs here, and I looked at what the US had done the previous night, I thought, oh, maybe this isn't going to play out. Maybe we're back to the same old story of hit the 50-day moving average and rebound back to new all-time highs. So I covered the hedge. I covered it on this day here. And then lo and behold, we open up today and we start trading down. So look, one of the things with trading and the trading space is that you just got to take the ego out of it and not get fixed on, I've got to be right. Like, I'm happy to flip-flop my view on these things based on what the market does. So with the market looking a bit soft again, I put the hedge back on today, on Friday. So look, I really don't care when I'm wrong. It's about like managing your risk. There's no ego involved. It's not like some people have this idea it's them versus the market. It's just like the market's doing what the market's doing, and we're just trying to adapt and adjust to what we're seeing. So when I thought the market was breaking back higher, it seemed sensible to cover, but that wasn't right. I probably should have held it for an extra day, but I've corrected that mistake and I've gone short again. And well, it's not really short, it's a hedge. I buy through buying this BBOZ ETF, which is a bear market position. It gives you double your exposure to what you invest. So if you put in $10,000, you kind of got about $20,000 worth of exposure to the market going lower. But look at their website, BBOZ. Look at their website if you're interested in that sort of product. And so look, that's what I've done. That's my concern that we might see over the next few days. So we shall have to wait and see. But I thought I'd have a quick whip around the some of the other markets. And look, have a look at the Nikkei. So this is why I don't think something big and scary is developing, because usually when you get these, big market events or really big corrections, it's a global thing. You look at the Nikkei, it's up, it's making new multi-year highs. So to me, that's not setting up for a big decline. And then I'll look at the at an emerging markets ETF in the US. So this covers pretty much global emerging markets, and that's not at this point, that doesn't look like a bearish setup to me. It looks like it's had a big rally, it's having a big sideways consolidation, and it's setting itself for at some point doing that. That's what I think could happen in the future. It doesn't look like it's all geared up to a collapse. So again, a lot of the evidence which I'm seeing is suggesting that we're not heading into anything dire, but it does feel like we could be heading into more of a pullback. So we'll just quickly look at another market. Just quickly look at gold, because gold had a bit of a rocky sort of night last night. Decent move to the downside. But look, I just want to bring this back to keeping perspective of the bigger picture possibility in this market. And look, the way I'm seeing this is that we had this big move up like that. At the moment, we're in a look at the slope of the arrows. The slope on this downward arrow is clearly a lot shallower than the one on the way up. So to me, that's very corrective. It's very consolidation-like, and I think we're setting ourselves up for something like that. But if that happens, could be wrong. Maybe it does. Maybe it does continue to unwind. It works its way back down there. But I don't think so. But if this does happen, I don't think we're there yet. I think it's going to take more time. I think we're still, how much more time do we need before we get up there? Doesn't look quite set up yet. I think that's where we're heading at some point. But look, I don't think there's a hurry to steam into gold, and last night's price action kind of suggests why that may be. Let's just wait for the price action to tell us gold's ready to go. One stock I was looking at, I look at all the gold stocks, wrong one. But look, North Star's an interesting one. I was just looking at this, and look, so we're sitting on this big support zone. Looking at this on a daily basis. So we're sitting on this big support zone at the moment. It's and what I saw when I was having a close look at it, just in here, there's actually a bullish wedge formation potentially on the make, potentially setting up. Let's draw it in there. So look, this is interesting. So we're on support. We've got potentially a bullish wedge. So the way a wedge works is that as it comes down, it continues to lose its downward momentum until finally the momentum exhausts itself, and you get a breakout to the top side. So you get a there. So that's how a wedge potentially works. It may not continue to form like that. Sometimes these continue to roll over and head lower. It hasn't. It's not a bullish break until it breaks, and we haven't broken at the moment. So maybe this does continue just to drift, and maybe even breaks its support. But look, for anyone who wanted to be aggressive on gold, look, I like to buy with the trend. I don't like to pick the low. I don't like to preempt turns. I've done it too many times, and too many times it hasn't been successful. Sometimes it does, and that's great, but more often than not, picking the turn is a fruitless exercise. But for anyone who wanted to be aggressive, this is one of those asymmetric moments where you could say, I'm going to the bottom base of this support around here. I could put an exit level. Say there, just below. Just below $8.50, just above $8, somewhere around there roughly. And if this support holds and if this bullish wedge plays out, well, maybe gold, maybe North Star's on its way back up here. So then you just do some calculations and say, well, okay, well it's 10% down to my stop loss, but if this were a point where it starts to go higher again, it's almost 100% back to the highs. So it's a 10-to-1 payoff ratio. Look, this isn't a play I'm doing, but look, it is a legitimate strategy. Traders do buy on support and they'll put their exit points below support. If it bounces, they're in the game. If it doesn't, they close their position. Just look, there's different styles, different approaches, and that's one of them. I'd probably wait. I'd like to wait and see if it broke. Maybe I'd be looking to buy in around $10 possibly, and slightly larger stop loss. But I'm then going with some momentum. Different ways to do it. Depends what you like, how you like to play it. Okay, well, please give me a like if that was helpful. Let YouTube know that it was helpful, and I'll leave it there for this week. And look, go out there, find some good trends. Let's see what happens. It's going to be an interesting week in the markets, I think. And we'll regroup next Friday and do it all again and see what's happening and see if we can put those pieces of the giant financial markets puzzle together. So thanks for joining in. Look forward to joining you next week.